Okay, so welcome to the session, everyone. Let's talk about international NPV in the today's session. Now, first of all, the question comes in, sir, why are businesses going from one country to another? Why are they not happy in their own business? So now the point that no simple business or no single business is good enough, or no single country is good enough that it will have all the resources. If I talk about a country, let's say India, so we have a lot of resources when it comes to the human resource, right? But if I talk about technical point of view, definitely we are not that good. Let's talk about China in that. Or let's talk about Japan. They are very strong when it comes to the technical resources, but they are not that good when it comes to the human resource, everyone, right? So these are certain things that we have to remember while starting this international NPV. Okay. Now the point, ki sir, okay, that is one point, ki why are companies going from one business to another business? But is it good enough? Is it enough? See, not only that, if I am working, let's say if I am working in just one country, that will give me the customers of that country only, right? But what if I want to go and enter into European markets, Middle East market, or any other market, everyone, right? Then how can I do that? Is it possible for me to do that? Absolutely. Now, a world is a very small village for the time being, everyone, right? With the access of internet and all these things, we can enter any market with absolute ease. Now, let's say your country is entering into any X country, your business is entering into any X country, right? So definitely you will again do a investment appraisal, you will do a NPV analysis and all that. Now my point is, guys, when you are going to do NPV analysis, you will definitely deal with international inflation, you will definitely deal with international taxes, and you will definitely deal with international exchange rates. Now, the question comes in, how are we going to take care of all these things? Are you clear, everyone? The question is, how are we going to take care of all these things? And in this session, we are going to answer these things only. Now, the very first thing, I'll just let me note it down, everyone. International NPV. So this is the newest part, everyone. Okay, so first of all, no single country is good enough. That is why countries come together. But one more thing, everyone, a developing nation does not want a developed nation to be a part of their business or their economy. That is why they impose trade barriers, everyone. Trade barriers mein beta, they might use quotas, they might use tariff rates, and tariff are something that is a lot in the news because of the Trump government as well. They place exchange controls, they put down certain administrative controls, and maybe cartels or anything to stop any foreign company to enter their market. Because we all know, if a foreign company will enter our market, it is going to disturb a lot for our, it is going to be a big disturbance for our own companies, everyone. That is one of the reason, right? So now, but because there are certain national or international agencies that promote world trade, that want countries to open up their economy, to build better relation. That is why we have certain agencies like World Trade, WTO, I don't remember, World Trade Office or World Trade, sorry, I forgot the name. World Trade Organization, sorry, yeah, World Trade Organization. World Trade Organization is there, then IMF is there. What are they doing? They are trying to build a secure, happy relationship all over the world. They are trying to ensure that there is a multilateral trade network, there is a bilateral trade network is there. Now, my major question over here, guys, there can be a question on role of IMF and see, there can, what can be the theoretical question? First of all, कि why do companies don't, why are government not letting companies to come together, or a global company to enter into their market? That could be one question. There can be a question on role of IMF and WTO as well. Read it. And or even World Bank as well. These are the certain questions that can be tested, everyone. Now, a lot of financial things are there that we will be discussing sometime soon as well. What are the international finance that is available to us? We'll be talking about that part as well. But today we'll be covering more onto the international NPV. So what are the important things that we have to remember? First is forecasting exchange rate. What is my future exchange rate? Second will be the tax part. Second will be the tax part, everyone. Now, and third would be your intercompany's cash flow. That is also very important. So first of all, when I talk about forecasting foreign exchange rates, okay, that thing is very important, everyone. How can we forecast foreign exchange rate? Now, if we want to forecast foreign exchange rate, guys, we have a very huge table for that. Okay, everyone. So this is one or basically four formulas that are given that we will be using to find out future exchange rates, everyone. So we have already talked about these things. We have 2 points over here. One is your international Fisher effect. Okay. One is your international Fisher effect. Other is your expectation theory. But generally we'll be using either these two or these two. Always remember F0, S1, same thing. F0 is current forward, H1 is expected future, spot. So the same thing. Okay. All of these things are equal. In a simple language, in a simple, very nutshell language, if you have inflation of two countries, or if you have interest rate of two countries, you can find out the future exchange rates of that country. Given you have the current exchange rates. As simple as that. If you have either the inflation rates or exchange inflation rates or the interest rates and the current spot rate, you can find out the future rates, everyone. So this is one formula that is given, everyone. Just to read it very carefully. 1 plus IC divided by 1 plus IB. IC is interest. C means counter currency, yani other country. B means base currency. Okay. Counter currency and base currency, everyone. F0 is forward, S0 is spot. HC, inflation of counter. Always remember, counter currency will be on the numerator, counter currency on the numerator, base currency on the denominator. Because how do I used to remember this formula? In India, we follow something that is called as Athithi Devo Bhava, sorry. And what do? We try to keep our guest above us. Always above, always above. Just a way to remember this formula, although it's not that tough, but yeah, you can remember it like that. Okay. So now let's solve one simple question based on this formula only. That will actually help you to get an idea on how we are going to solve this thing. Okay. So this is the question that we have, everyone. Now, if we talk about this particular question, we have the exchange rate 1.7025, 1.7075. But in these type of question, we have to take a middle exchange rate, which will be 1.7050. Correct? This is the middle one. This divided by 2 will give me 1.7050. Simple. Now we are always in UK. This is the basic rule that we have to follow, that I am in UK. Okay. Now 1.7050, but this is spot, matlab today's exchange rate. This is spot, today's exchange rate. I want to find out, matlab this is zero, year zero. अब I am going to calculate for year 1. यूएसए का कितना है बेटा? 1.05 divided by 1.02. 1 plus IC, remember? 1 plus IC. That's what I'm taking. Okay. It will give me how much, everyone? 1.7551. Now I'm going to use this. This is my spot now. 1.7551 multiplied by 1.0304. 1.03 divided by 04. 1.7382. Then I'll use this 1.7382 multiplied by 1.04 upon 1.04, which will give me the same thing. Right? But what I'm doing, I'm using this 1.7551, 1.7382 as my spot rates. And then I'm trying to solve this question. Okay. So this is how even you guys can calculate your, sorry. You guys can calculate this kind of question. Okay. Now there can be a question on cross rate. Matlab guys, they might give you dollar by pound, they might give you euro by pound, and they will ask you to calculate what could be the dollar by euro. They might ask you that. Simple. Dollar needs to be on top. Keep, let's say this is 1.9, this is 1.45. This is simplest example that we have in our exam. Okay. So what we want, dollar by pound. So dollar will be on top. Keep this rate on top, 1.90 upon 1.45, whatever the exchange rate, 1.31. This is called as cross exchange rate. Cross exchange rate. Okay. This is called as cross exchange rate. Okay. Now, inflation is also very important. But inflation can keep on changing. So you have to remember that you have to use that kind of inflation. Now we have taxation. Now we have tax. And within tax beta, there will be a concept of double tax treaty. What is the name of concept? Double tax treaty, DTT. Double tax treaty. Now, within this concept, remember, let's say we have two countries. Okay, we have US and UK. Let's suppose in US you are paying, you are country of UK. US में you are paying 40%, UK में बेटा you are paying 30%. Situation number 1. Situation number 2, US में बेटा you are paying 30, UK में you are paying 30. Situation number 3, US में you are paying 20, UK में you are paying 30. Now let's assume there is a double tax treaty. So beta, if you are already paying 40% tax in US, so you will only pay 0% tax in UK. Why? Because you are already paying 40%. There is no requirement of paying any tax in UK now. Again, you are paying same tax, so you will pay no tax. Now over here, you have paid 20%, so you will pay the leftover amount, which is 10% of tax. This is the concept of double tax treaty everything. Okay. Now, again, there will be one more thing that is called as intercompany cash flow. Okay, intercompany cash flow. But I always remember, whenever there is intercompany cash flow, there will be a concept of transfer pricing. Now, this concept is little tricky, but very simple. Okay, now just listen to the story. Let's say you have a company which is based in India and you have one more company which is based in Dubai. Okay. Now, beta, you notice that the tax in India is very high, but the tax in Dubai is very low, right? Tax in Dubai is very high. Sorry, India is very high, but tax in Dubai is very low. Now, what will you try, guys? All of you will try to ensure that most of my profits will flow from Indian company to the Dubai company. That's what you all will try. So let's say you thought that. And what you did, beta, let's say you were selling your goods at 10 rupees to all other companies. But to that Dubai company, you started selling your goods at 4 rupees. So what will happen in that situation? The company which is in India will have the lower profit, and the company which is in Dubai, which is buying a cheaper good, earlier it was buying at 10 rupees, now it is buying at 4 rupees only. So beta, what will happen? Its profit, the profit of that company will go up, right? And that was my task. I wanted that company, my my Dubai company to have a higher tax or a higher profit, because on that higher profit, I am going to pay less tax. And in India, I have a low amount of profit, so I will pay less tax directly. Now, there is one more thing that we need to, okay, within transfer pricing, everyone. So now this is what is happening. So now government noticed that and they felt ki yaar, this company is working in my country, earning profits in my country, and it is giving it to someone else. Just a second, everyone. Right? It is giving to someone else. Now what we want? Government said ki yaar, you cannot do this. You cannot sell your goods at such a cheap price. You will have to follow transfer pricing. Matlab, at what price you are selling it to everyone else, you have to use that same price and then you have to go and sell it. So this was the concept of transfer pricing, everyone. Okay. But again, there were many loopholes that humans found out. They said, okay, chalo, koi baat nahi. Now what they did, guys, they sent their management guy. Okay. And they said, bhai, this management guy will charge $200 or $2,000. Now you cannot ask ki bhai, how can you charge $200 or $2,000, right? You cannot go and charge $200 to $300. Why? Because it's a professional fees, and that fees could be anything. It is not a product; it's a service, and service charge could be any price, right? Because it's a professional service. So again, we people found out what could be the hacks to do that. So within transfer pricing, there will be two companies, company A, company B. Company A ka beta, their profit will be, let's say tax is 20%, and over here tax is only 5%. What we will want? Over here we want low profit. Over here we want high profit. Right. So this is what we will do. We'll shift our money from here and it will sell goods at an expensive price. So this is what we might do, everyone. Take it to find out or to ensure that we are earning more as a group. This is the concept of transfer pricing. Now let's take a very small question, which is of international NPV. Okay, this will give you a clear idea on how international NPV is going to work. देखो, a project carried out by a US subsidiary of a UK company is due to earn revenues of 100 million. So what is revenue? 100. It is in dollar right now, ठीक है? Dollar million. With associated cost of 30. Okay. Royalty payment of 10 million dollar is also going to be there. So, but I'll charge royalty of 10. Right. So what is my net profit right now? 100 minus 30 minus 10, 60. Now, tax is 25% in US. Okay, this is my pre-tax profit, by the way. I'll charge tax at the rate of 25% in US. 60 ka 25% is 15, everyone. However, I'm left with 45. Now this 45 I will send to UK. Exchange rate is given as 1.5. Correct? So this is $45. Now, if I divide this by 1.5, but it will become how much? 30. Now we have this as pound ka cash flow. Is how much? 30. Now, that is the only thing that we have wanted. But beta, over here we have royalty. We have paid a royalty. $10, $10 million. That royalty is given to whom? My UK company. Correct. So beta, this will come over here. This will come over here. That $10, 10 million will be converted by 1.5 and it will become 0.7. It will become 6.7. What happened, sir? Beta, this 10 million, the royalty, that was paid to my UK company only. So for my UK company, that is what? It is a revenue. So I will take that money, I'll take that money, plug that money and put it over here. So 6.7. So now my total cash flow would be 36.7. But this was US tax. Now I will charge UK tax. Guys, I will charge UK tax. Now just think for a while. I will charge UK tax on two things. First of all, 33 and 25. So I am supposed to pay how much? 25 and 35. I am supposed to pay only 8%, right? The difference between these two, 8% tax. But 8% tax will be paid on this 60. Correct? Beta, because 60 pay we have already paid 25%. So I will only pay how much? 8%. So I'll just put down a working over here. ओके, यहाँ पे करते हैं. ठीक है. Now 60 million divided by 1.5 will give me 45, I guess. 40, sorry. 40. Correct. Now this 40 is pounds. Correct. This 40 is in pounds, everyone. Now on that 40 I will pay how much tax? 40 into 0.8. 0.08, sorry. 0.08, which will give me 3.2. 8 was a 32. 3.2. Correct. And this 6.7, beta, this 6.7, on that 6.7, I have to pay the complete 33%, yani 0.33, which will give me how much? 2.2. Correct. So my total tax will be how much? 4.4, sorry, 5.4. 21.3 pounds million. Puxty PLC is a specialist manufacturer of a window frames. Its main UK manufacturing operation is based in south of England, from where it distributes its product throughout the UK. The directors are now considering whether they are opening. Okay, chalo, that is of no use. A suitable factory has been located just outside the Paris that could be rented on a 5-year lease, everyone, on at an annual charge of 3.8 payable each year in advance. But advance ka matlab it will start at the year start only, so we will start from 1 year early only for the cash flows purpose. The manufacturing equipment would cost 775, of which 60 would have to be paid at the start of project, with balance payable 12 months later. Okay, that is fine. At the start of each year, the French factory would require reworking, everyone, which will be equal to 40% of that year's sales revenue, if it is expected that the factory will be able to produce and sell 80,000 window units per year. Although in the first year, because of the need to run in the machinery and its new workforce, output is only expected to be 50,000 window units. Each window is likely to be sold for 750. Okay, first year ka beta sales is given, and then for the next year, sir, it is given. Is likely to be sold for 750, a price that represents 150% markup on cash production. Okay, it is markup, not the margin. Remember that. A French factory would be set up as a wholly owned subsidiary of a Puxty PLC in France. 25% straight line depreciation on cost is an allowable depreciation expense against the company. Okay, that is fine. No UK tax would be payable on after French tax. Any double tax treaty is there. All amounts are euro given in the current terms. Annual inflation in France is expected to be 6, but an inflation is directly given as 6%. Okay, right. To protect its patent rights, Puxty PLC will charge its French subsidiary a fixed royalty of 20 per window. So there's a concept of royalty as well. This cost would be allowable against the subsidiary's French tax liability. The current rate is given. Inflation in UK is expected to be 4% over the period, and beta 6% in France. That is already given. So now we have the UK inflation and France inflation. So we can calculate the exchange rates as well. Take the current annual rate. Over here we can calculate the cost of equity to find out the discounting factor. Okay, so this is pretty good question. Now let's start from the scratch, everyone, starting with the sales revenue. The number of years that we have to consider will be 0, 1, 2, 3, 4, 5, 6.
Sir, can you send the full question in the WhatsApp? Sir? Only the first part has been sent.
Okay, I haven't sent the full question.
Yes.
Just a second. You guys please keep an eye on the question as well. Okay. Is it fine if I solve this question just over here only? Because it's pretty big. It will take me a lot of time to go and check again and again. Okay. So
Yes, sir, it's right.
0, 0, 1, 2, 3, 4, 5, 6. Okay. Starting with sales revenue. Is it fine? Can we do one thing, guys? Can we please put down all the sales amount, which is actually almost the same only, 50,000 and 80,000 and all that. So let's do one thing. Let's remove all the thousands. That will make things a little easier for me. Equal to 50 multiplied by what is the price? 750 into bracket. But now I'll put down 1.06 raised to the power 1. I'll do one thing. Although we don't need to do anything over here. Press enter. You get the final amount. I'll just drag it over here, and over here 50 I will make it 80, everyone, and then I'll drag 75 80293 8511. Okay, year 6 is not required. Year 6 will be used for the tax purpose only. Okay. Okay, Ashwin has given me some doubt. Hi sir, this is my first class and I'm a student from PES University. How can I answer this question easily? Ashwin, you have to just go through the complete question first. I'm telling you on how to answer this. First, understand how to answer, then let's talk about how to answer easily. I had a doubt. I went through the materials and found this. So could you please help me out? How is macro duration different from modified duration? Okay, so we just talked about it before we started this class. Would you like to answer this question, Arvind? Because this is what we discussed as soon as we started, right? How is modified duration and macro duration are different?
The macro duration is that
I guess Ashwin
with
was Rafiz was there. Ravandan was not there when I discussed this thing.
yes, sir, but I studied the technical
Okay,
articles.
yeah. Great. Let me know. Let him know.
So, like if we invest amount today, within which year we will get our money back, that's the macro duration.
Hmm.
And in terms of the modified duration, if there is a 1% increase in the interest rate, what will be the when will we get the amount?
Okay.
So the effect of that increase in interest rate.
Okay, great. So when I talk about macro duration in a very simple language, macro duration beta tells me ki on an average, when will I get my money back? Now you might ask, sir, this is simple, very much similar to payback period. But beta in macro duration, we provide weightage based on years. Okay, so some amount which we are getting in year one will provide a particular weightage to that. For your exam purpose, for your ACCA AFM purpose, we provide one weightage to that. In real life, if we are receiving a higher cash flow in a particular year, if we are receiving a bigger cash flow in a particular year, more weightage will be provided to that year. That will be your duration. So based on the weightage of the duration, we calculate ki on an average, when will I get my money back? This is your macro duration. But when I talk about your modified duration, it tells me ki sir, if my interest rate changes by particular percentage, if my interest rate changes by particular percentage, how is it going to affect my bond price? How is it going to affect my bond price? Although both the names suggest duration, modified duration has nothing to do with the duration part. Modified duration is more of a sensitivity that helps me to understand ki if there's a particular change in interest rate, how will the bond price change? Got it, Ashwin? Is that clear, Ashwin? Okay, great. Chalo, let's move back to the question now. We have the sales revenue. I just bold it for understanding. This is my sales revenue, everyone. Now, after sales revenue, what was the second thing that we had? Was that operating cost? Just a second, everyone. The manufacturing equipment would cost 75, of which 60 would have to be paid at the okay, this is manufacturing equipment cost. No, that is not required. And okay. Now, one thing beta, that this price, the sales revenue, it is 150% markup. Yani cost is 100 plus 150% markup. This is what is my sales revenue. Right? This is what is my sales revenue. So now if I want to find out my production cost, so is it safe to say that this represents 250% of the cost? And I just want 250, I can write it down as, let's say 250% upon 100, 25.2, 2.5, sorry. Right. So if I want my production cost, that is nothing but this amount divided by 2.5, which will give me the current value, the production cost. Again, but this sales revenue is 150% markup, which makes it 250%. I want to find out the value if it is only 100, if it is only 100. So what I did, 250% ko beta I denoted as 22.5, divide by 2.5, you will get the value of 1. Simple. Right? So now, after production cost, can we go and check anything else that, okay, that could be a rented on a 5-year lease at an annual charge of the rental. Lease rent is going to be 3.8 from the start of year. So it will be 3.8 from here till year number 4, everyone. Okay. Then we have royalties as well. 3.8 is done. Likely to sell for 750. The French factory would be set up as a wholly owned subsidiary, 25 state. Okay, we'll talk about it later. Let's find out all the cost. 6% inflation will charge its French subsidiary at royalty of 20 per window. The royalty is how much? 20 per window, right? And this amount is given in pounds. Abhi I am solving everything in euros. So now I have to go to another working before I move forward, everyone. I'll put it down over here. Workings, working number 1, exchange rates. Because beta, I have to convert all the royalties. That is why it is important that I find out the future exchange rates, right? So now exchange rates, pretty simple to calculate. I'll just copy the years from here. Okay, year 0 mein beta, what is the exchange rate? 1.5. Okay, year 1 pay, it will be this amount multiplied by, what is the French exchange rate given, everyone? 6% inflation. Sorry, inflation is 1.06 divided by my country inflation, which is 1.04. That will give me 1.528. Just drag it and that's it. You don't have to do anything else. Just drag this thing and that is good enough. Now royalties. The royalty is directly given as 20 per window. So it will be equal to how much? 20 multiplied by year first में बेटा I am making 50,000. So 50 multiplied by whatever my exchange rate is multiplied by that 1528. That will be the value. Over here I'll drag it and this 50 I will make 80 and then I'll drag it. Okay. So this will give me the value of my royalty, everyone. 152.8, 2493, 2541 and all that. Okay. This will be the value of my royalties, everyone. Now let's move to the tax charge, everyone, which is again very important over here. Now notice one thing. Abhi beta, I haven't charged any depreciation over here, right? I haven't charged any depreciation. But in these type of question, either you can go for the tax allowable depreciation, add the tax, do that, or you can just remove the depreciation, calculate the tax. Correct? Because in these kind of businesses, there can be a situation. Just read. Tax is payable at 40% at each year end without delay, and any unused losses can be brought forward for set off against the following year profit. But whenever this line is given, na, there are very high chances that there will be some loss in year one. So I always suggest everyone to please remove depreciation over here. Please remove depreciation in this type of question. So I'll do one thing. Why don't I go and create a working for the same? I'll copy it because it is not going to take a lot of my time. Working to tax. Okay. Over here, I just need to pull down depreciation. Yeah. See why am I suggesting everyone to create a working and not to go for tax allowable depreciation? Because in this question, it is given that there can be certain loss in year one. So if you go with tax allowable depreciation, that will not give you a clear answer and you might get confused while solving. So to find out my actual profit, it is very important that I go and remove my depreciation as well while calculating the net profit. Okay, so I'll just pull down the depreciation. Now, what is the amount of depreciation, everyone? Let's check. Total value is 75, I guess. 75. No, that won't impact your marks if you show it over there as well. But I want my answer to look a little more professional. That's why I'm not doing it. It won't affect your marks, but why to show it? Why to confuse the examiner, right? Let's see what is the inflation. 25% straight line. So depreciation is going to be how much, everyone? Will be equal to 75 divided by, yeah, multiplied by 25%, 18.75 for 4 years. That's it. That will be your depreciation, everyone. Now, can you find out the taxable profit? That will be equal to this amount minus this amount minus. Okay, so there is some mistake over here, I guess. Okay, so although this should be a loss, everyone. Now, what has happened, because I have taken double zeros in the calculation of sales revenue and lease ko beta, I have completely forgotten. So this is 3.8 million. So I need to pull down 3800 at least. Okay. I have to represent it as 3800. Or I can remove the zeros from here. There are only two ways through which this can be solved. Okay, so let's do one thing. Let's do this question as a whole. Might help everyone. 50,000 and 80,000. I'll write it down as 000. So I remove. Okay. Okay, so what I did everyone, I just adjusted all my zeros to make calculation a little easier for me. Okay, so this will be my profits for the coming year. This will be my profit. Now over here, beta, remember we have a loss in the last year. Okay, so I'll calculate my tax. Over here it will be 0. Over here it will be this amount. I'll just do a bracket. This amount minus this amount and then multiplied by what is the tax rate over here? 40%. Over here it will be directly 40%. Multiplied by 40%. So I'll pull down net profit. So I'll pull down sometime later. I just wanted to calculate my tax over here, which is 6254711 and 8123 and 1824. Okay. But all one more point over here. Rental charge over here. Rental charge over here. But a rent relates to that year, right? Although for cash flow purpose, I'm taking it a year earlier, but over here I'll take it for that year only. That is why I removed it from 0 and put it over here. Okay, don't get confused why I did that. Now I just want to pull down all the royalties and everything is done. I can just write down tax charge equal to minus this amount. That is minus this amount directly given. Now investment 60 in year 1, 15 over the next year. Okay, this will be 60 million, right? So 60, 1, 2, 3, 15, 1, 2, 3, because we have adjusted all the zeros. Then we have scrap value, which will be at year 5, and it is given as, what is the scrap value, everyone? Just a second. Working capital. Okay, production equipment would have a scrap value at the time 70 million before tax. Wow, that's a great thing. So 70,000. Okay, before tax. Okay, now beta we have to process on asset sales are taxed at 40% as well. So यहाँ पे भी we have to put down a tax. So we charge 40%. So we are left with how much, everyone? Multiplied by 60%. 42. Simple. Then we have something that is called as working capital. Okay, working capital, everyone. Now what is going to be the amounts of working capital? Again, another working. Working capital. What is the working capital amount? Require working capital equal to 40% of that sales revenue. Fine. Total working capital required will be equal to 40% multiplied by right? This is the total working capital which is required. Now I'll pull down net working capital required. So year 0 it will be required this amount minus this amount. This is what is required, this amount. So I just need to drag everyone. At the end, I'll get all my money back. Right, 32117. That is what I will get at the end of everything. Now working capital may I'll go and pull down negative from over here. Right, this is what I have to do. Abhi year 6 ka we haven't used anything at all, right? Year 6 is almost nil for the time being. Now all the cash flows which relate to the euros have been done. So can we go and find down the net cash flow in euro? That is not required that you write it down, but it is fine. So it will be going to be this amount. Lease rent is also going to be there. Plus this amount. Plus this amount. Okay, I am just minusing because minus minus will become plus. Over here, if you come, sales revenue minus production cost minus lease rent minus royalties minus investment plus sorry, minus to will become plus. So over here I am doing a plus 7545 everyone. I'll take all the cash flows last year पे बेटा I'll just add scrap value. Have you not taken the tax, right? Okay, minus tax as well. Okay, that's this. Now we have all the cash flows which are required everyone. 7545. Okay, so now after all these things are done, we can move to these cash flows are in euros everyone. Although one more thing everyone, see, in this kind of question we might make a mistake on the zeros wala part because there are like lot of things which does not have triple zeros and double zeros and many more things. So whenever these type of question are given, it is better that you solve it for all the number of zeros. Okay, please do that. I am not doing that. So now we'll move forward. We have the cash flows. Let's convert them. So this amount divided by this amount. All the cash flows I can directly get. I don't have to worry about anything else everyone. Okay, one more thing over here. Okay, now that looks fine. We have converted it everyone. Again, I'm getting it. Okay, so now we have converted and this is my major cash flow everyone now. Okay, so now what I need to do everyone will have to take care of the royalties wala part. If you remember guys, royalties is something that we again have to worry about. Royalties. Beta over here we have charged 40% tax. ठीक है. अब how much tax do we have to charge on my government? 35. So on to these cash flows, I'm not going to charge anything. Right? Now what is the amount of royalty? What is the amount of royalty everyone? Okay, so I'll go to the royalties wala part. I'll take up this much. Equal to 20 multiplied by 50. 1000. And over here it will be 80 multiplied by 20. 1000, 1600, 1600 and 1600. ठीक है, after royalties beta we have to pay tax on royalty. So tax is going to be 35%. We can directly multiply them by 65%. So we'll get the direct price. Correct. We don't need to do anything. Multiply by 65%. Royalties after tax. Simple as that. Okay. So now I'll reach to the net cash flow. That will be equal to this amount only. Over here it will be equal to this amount plus this amount because royalty is a benefit for me. So I can directly add it everywhere. Okay, one more point, guys. Over here, just take a look. Tax is paid after 1 year. So I cannot do this thing. I cannot do this thing. I have to take it little below. I have to charge tax on royalties. This 65% won't be at this year. If you just look, everyone, this is not charged on that year. That is 1 year in arrears. Okay, good question. Yeah, it's a tricky one. So this amount multiplied by 35%. And that's how it will go on. Okay. So now this will become 3935. This will become this amount plus royalties minus tax. This is all the amounts that we will get at the end. Right, everyone? Now we need the discounting factor, everyone. Now we need discounting factor. So over here we can use the discounting factor as an all equity finance company. So I'll go to working number 4. I'll put down discounting factor, bold it. What is the risk-free rate, everyone? 10%, 10 plus what is the beta given? 1.25 multiplied by what is the differential? 18 minus 10 yani 8. 20. So my equal NPV will be 20%, comma, all these points. So what is the final? This amount minus this amount. So this will be my NPV, everyone. That's a positive NPV, 1351. So this is how your big exam style questions will look like, everyone.